Welcome everybody to this week's version of Wealth Wednesday. Today we're going to be talking about health savings accounts, HSAs as they're often known as. And we're going to be explaining a lot of different aspects to these accounts, everywhere from what they are to certain rules you have to and regulations you have to abide by, how to invest those HSA accounts, and more. And so this is retirees' most tax advantage account. So it's something that you're definitely going to want to make sure that you look at as an option for your retirement because it can be pretty powerful. And we're going to talk through a lot of that. Kind of already talked through a little bit of this today, but we're going to be talking about all areas of HSAs, talking about how they fit in with just in general planning for retirement healthcare costs, and also how they compare to some other healthcare accounts out there as well. So let's go ahead and get right into it. What is an HSA? What is a health savings account? Well, it's the only that I know of, or at least out of the top of my head that I'm thinking right now, it's the only triple tax savings account that's available to retirees. Okay, so let's think about other accounts that we have that have some tax advantages to them. Let's think about our traditional IRA, our 401k. Okay. When we invest in a traditional IRA, when we contribute, we get a tax deduction. Okay, so we don't pay taxes right away. Our full contribution goes in. But then when we take money back out, that's when the tax man finally gets what they're owed. Okay, so we're taxed on withdrawal. A Roth IRA is basically flipped. Okay, we pay taxes on the contribution, but then from there on after, we don't pay any taxes. So that money can grow. We might put in $10,000. That grows to $1 million eventually. And that million is completely tax-free. So we pay taxes on the front end rather than on the back end. Now, HSAs are the only account that essentially you get to exit the tax system. Okay, you get a tax deduction as well as tax-free growth and tax-free withdrawal. So HSAs, there's no tax on the contribution. Okay, so you get that same tax deduction in a given year, just like an IRA. That money can stay invested, and there's no taxes, whether you buy or sell, there's no taxable events while it's growing. And then when you withdraw that money out, if it's used to pay for qualified medical expenses, there's no tax on the withdrawal either. And so the money that you put into an HSA basically gets to exit the tax system. Uncle Sam doesn't get to touch it at all. So we can start to see how that's an incredibly powerful account. Okay, for instance, if your top marginal tax bracket in a given year is 22 or 24%, and you contribute to an HSA, you're essentially going forward into time, you're essentially getting a 22 to 24% discount on your healthcare costs. Okay, when you add in state taxes as well as payroll taxes, it's even higher from there. And so this is an incredibly powerful account for retirees to use. We know we're going to have healthcare expenses. So if there's an account that we can use, we can contribute to that exit the tax system, we're essentially saving, anywhere from, let's call it 10 to 50% on taxes when all things are said and done, depending on what state you live in, depending on all those different things we can think about. So unfortunately, there are limits on how much you can contribute in a year, same as there is for IRAs and Roth IRAs. For a married couple in 2021, the base limit is $7,200. So essentially $3,600 per individual, $7,200 for a household. Okay, now if you're over 55, you get a $1,000 catch-up contribution. Okay, so essentially in 2021, the maximum that you can contribute to an HSA is $9,200 for a married couple. Okay, now we often quote a health savings account as a triple tax savings, and I'm going to continue to do that throughout this presentation, but a case could be made there's actually quadruple tax savings here as well, making it that much more powerful. And the reason being is because your contribution to an HSA also, the deduction also applies to payroll taxes. So what are payroll taxes? Well, they're often referred to as FICA taxes, basically Social Security and Medicare taxes. Now, when you contribute to a 401k, those are not payroll deducted. Okay, meaning that contribution, you are still being taxed if you're the employee, 6.2% for Social Security, 1.45% for Medicare. And so that's an extra tax that even contributing to a 401k, you don't get that deduction. Well, guess what? HSAs do receive that deduction. So for the average person, that's going to be 7.65%. that they also save on taxes. So when you add that in as well on top of this tax savings, the discount for your healthcare down the road will be even larger. So this is one of the most powerful accounts, and something I think if you qualify for, everyone should be setting aside money to contribute to these accounts. I would contribute to these accounts. Obviously, we would take a match from a 401k, but after that, I would argue that an HSA is probably your most powerful account. Okay. So let's keep going through and talking through what details about an HSA that you need to know about. Okay. Well, HSAs are often offered through employers, but don't have to be. I will say the majority of the time that we meet somebody that has an HSA set up, it's because their employer has a high deductible plan and they offered an HSA through through an employer plan as well. However, don't be mistaken that just because your employer doesn't offer this, that you can't have access to an HSA. Okay, you can have an independent HSA outside of your employer, set it up completely on your own. And we'll talk about what that looks like later in this presentation. But to qualify for an HSA, you need to be on a high deductible plan with specific constraints. Okay, in the next slide, we'll talk about what is a high deductible plan, what guidelines you need to follow to meet that. But the other qualification as well, you can't be on Medicare or TRICARE. So basically, once you're 65, you are then on Medicare. You no longer have the option to contribute to an HSA. Now, you can still spend out of an HSA, but basically, once you reach 65, HSAs are largely off the table. Okay. Now, contributions for an HSA, there's always different contribution deadlines. Contributions for an HSA are by tax day. So you basically have till April 15th of 2022 to make a contribution for 2021. Okay. Now, if there is a contribution mistake, and this invariably happens with people not necessarily understanding fully the rules with the catch-up contribution and which contributions have to go into which accounts and whatnot. If you make a mistake on the contribution, you can reverse that. Now, it will obviously be added to your taxable income. If you go ahead and you leave that contribution in your HSA, you'll have a 6% excise penalty each and every year for the contribution and then the growth from that contribution as well. So you're going to want to make sure you reverse that contribution, because basically, let's say that in a given year, I'm married and I contribute $15,000 to an HSA. Well, basically over that $7,200, I'll have to pay income tax. I won't get that contribution deduction. And I'll also have a 6% excise penalty until I take that money back out. Okay, the other thing that's important to know is this last month rule. Okay, basically what that last month rule is, let's say that you have to pick your healthcare options at the end of every year, November, December time. Well, the last month rule specifies that you might not have a high deductible plan from January to November. Okay, well, in December, if you switch to a high deductible plan, the last month rule basically specifies that the last month's healthcare is basically your healthcare for that full year. So if you switch in December, even though you had a low deductible plan for the entire year, you can still qualify because you switched basically in that last month. I believe the constraint on that is it needs to be switched by December 1st of that last month. Okay. Now, what qualifies as a high deductible healthcare plan? That's what HDHP stands for. Basically, this middle box right here, I'm going to grab my writing tool here just to outline it or underline it, highlight it, I should say. Basically, from an individual standpoint, if your deductible is $1,400, from a family standpoint, if it's double that, you can qualify for this high deductible plan. It's the minimum deductible. Just know there's a maximum out of pocket here as well that you need to pay attention for, but for most people, we're looking at this qualification for a high deductible plan. And a lot of plans do qualify for that. Okay. And so again, when you're thinking about what plan to choose for work, if you have great health, it may be worth going with a high deductible plan in order to qualify for this nice, powerful tax savings vehicle versus going with a low deductible plan that the majority of the years you're not going to use up that deductible anyway. So again, it depends on your health, and that's a discussion that's probably slightly outside of the retirement planning discussion, because we're thinking about what your healthcare needs are. But again, it should be weighed into as you're thinking about what healthcare option to go through through work. Now, one thing I will note is that if you're planning on retiring early and moving to ACA, now if you're moving to COBRA, some kind of continuation from work, you'll still be part of the same plan you were just at. But if you're moving to ACA, something like 80% of plans don't qualify for being a high deductible plan. Now, when you're on the healthcare.gov and you're searching through the marketplace, what you're going to want to look for is this right here. And you can even search through this as a filter, what qualifies as a health save, or if a certain plan is eligible for a health savings account. But this is what you're going to want to look for. The reason majority of ACA insurances don't qualify for a healthcare savings account is because essentially they offer additional benefits that disqualify them. So they'll offer cost sharing, or really just the deductible won't be high enough, or there's a myriad of reasons for it. But the majority of ACA healthcare plans will not allow you to be eligible for a health savings account. Now, what I will say is if one of you is on ACA and the other one is still at work, if one person out of a couple qualifies, both of you qualify. Okay, so that's another important thing to note. But essentially, if you're going on to ACA, you probably aren't going to want to plan for being able to contribute to an HSA. If you can contribute to an HSA, it typically means your ACA plan isn't that great. Okay, we can see here that we're looking at a $1,200 almost monthly premium, $11,000 deductible, $11,000 out of pocket. So this family can probably qualify for a lot lower with some decent retirement planning. So I said at the beginning that if you're using healthcare HSA funds to pay for medical expenses, those are not taxable on withdrawal. Well, what qualifies for these HSA expenses? Before getting into that, it's important to note that HSA funds can be used for you, your spouse, or any dependents that you have. So if your spouse doesn't have an HSA, but you have an HSA, and all of a sudden your spouse falls, breaks something, and you want to use those HSA funds for it, you can use your HSA funds for your spouse and vice versa. Okay. Only certain types of insurance premiums qualify for the use of HSA expenses. Long-term care premiums are one of those. COBRA premiums are one of those. If you're on unemployment or you're suffering from unemployment, you can then use HSA funds for those. And then Medicare premiums as well. Basically Part B, Part D, Medicare Advantage policy. What doesn't is a Medigap policy. So Medigap policy premiums will not qualify for HSA expenses. And then from there, we're not going to include a full list of qualified and non-qualified expenses. You can certainly look that up. There's a lot of great resources online for that. But basically, it's what you would generally think. So if it's to qualify for qualified expense, generally, if it's something that you need to fix for your overall health, that will qualify. Okay. Non-qualified expenses would be, let's say I want to get my lips done or something like that, some kind of cosmetic surgery. Okay. That would not qualify because it's not needed for better healthcare. Okay. If that makes sense. So most of you can, without even looking up a list, can probably read between the lines on what's going to qualify and what's not going to qualify on that front. Okay. So let's say you've contributed to, you have an HSA. What are the rules for distributing that HSA? Well, basically, regardless of your age, if you're taking that distribution for qualified medical expenses, there are no constraints really. Okay. You can be 25 years old, take from your HSA, and there will be no penalties. You can be 85 and take from that HSA. Once again, no penalties. So there's not really constraints if you're using it for its purpose. But however, if let's say you're in a situation where you feel like you have way too much into your HSA. Now, we really haven't seen that from a realistic scenario, but just for hypothetical reasons, let's say you have $1 million HSA somehow, okay? And you just don't think you're going to spend that much through the rest of your life on qualified medical expenses. Well, before 65, if you take from that HSA, okay, and it's not for qualified medical expenses, you're going to owe the tax. Obviously, it's treated just like an IRA if it's not for qualified expenses, but you're also going to owe a 20% penalty. So most people, we know normal accounts are 59.5. For an HSA, it's 65. So right at that Medicare age. After 65, you only will owe the tax. That 20% penalty is gone. So notice that normally it's a 10% penalty for early withdrawal. For HSAs, it's a 20% penalty, and the age is 65. So again, just a good thing to remember if for whatever reason you might be taking from that HSA to pay for non-qualified medical expenses. How is an HSA treated after you pass away? This is a common question because there's a fine line with an HSA. Because it's such a fantastic tax advantage account, you want to keep contributing to it. You want to keep it growing, but you might not want to keep it growing so much that by the end of your life, you don't use it all up. And so there's some fine line that every retirement plan needs to figure out. When do you start heavily spending that HSA money? Okay, so how is it treated after you pass away? What if, again, common concern, what if you over contribute to an HSA? Okay, meaning that you've been contributing for your whole life. You don't see that you're going to have enough qualified expenses in retirement. So you've over contributed. Your HSA is bigger than you can qualify for medical expenses to pull out of that HSA. Okay, well, for most people, this isn't really going to be a serious worry. Okay, the reason being is because, as most of you probably know and are worried about, healthcare costs are expensive, especially in retirement. Now, according to HealthView Services annual data report, they estimate the average couple in retirement will spend anywhere from $156,000 to up to $662,000 in healthcare costs through retirement. Now, obviously, that is a wide gap, and it makes sense because some people have, existing conditions in retirement that will move them higher up. Obviously, if you have cancer versus not having cancer, that can be a huge expense that gets added. So this is understandably highly variable, but any way you slice it, we're going to need a ton of money to pay for these healthcare expenses through retirement. And so saving up $150,000 into an HSA requires planning well ahead of time. And it's, I wouldn't say it's an impossible thing to do by any stretch of the imagination, but it's also not an easy thing to do. And so for the most part, most people shouldn't be that worried about over contributing to an HSA. The reason for this is because as we're planning through retirement, let's say just on a base inflation rate for retirement, we're assuming that CPI is going to rise by 2.5% through retirement. Well, that's great for your general basket of your income target, but that's not accounting for all the different inflation rates that you'll see. It's no secret that healthcare inflation has been increasing at about twice the rate of normal inflation over the past couple decades. Okay, and when we look at projected average annual inflation rates on healthcare costs for the next 8 to 10 years, let's say, you can see that we're expecting this higher inflation to continue for healthcare throughout time, or at least most experts are as well. Looking at Medicare, you're looking at 3.5 to 6% inflation rates. You can see over here on out-of-pocket costs, we're expecting some higher inflation as well. And I think this could, I think at the very least, this is under assuming from what we've seen over the past decade. So again, I would assume twice the inflation rate that you're assuming on CPI, assuming that for healthcare. And so your healthcare costs are going to grow through time as well. And we often show this in a lot of different presentations that we have, different phases of healthcare costs. So in the early years, let's say you retire before Medicare, okay, you're going to be on either Obamacare or COBRA. Well, if you're not careful on Obamacare, these can be very expensive years. Okay, if you're not positioning your retirement in order to take advantage of subsidies. From 65 on, you're going to be on Medicare. That's generally healthcare preferred. Okay. Nonetheless, though, it's still not cheap by most people's scale. Okay. And it's still going to cost some money, but generally healthcare preferred. And then finally, you reach those long-term care years, the no-go years. And obviously we know long-term care can be a fairly expensive expense. And so through these periods, there's a lot of different phases where an HSA is going to help you save on these healthcare costs, but there's no way you escape essentially how much healthcare is going to cost. Okay. So this is just a quick breakdown, just pulled from an example plan, just looking at what we're assuming for healthcare expenses through time. And I will say, when you're trying to think about your income target in retirement, what I would first start is what your income is going to look like from the things that you just basically need and want. So what would that look like? Groceries, utilities, housing. Okay, those things are going to generally grow by normal CPI. Travel and whatnot, things that you don't want to go out to and do to enjoy your retirement are going to grow at normal inflation rates. But I would urge you to split out taxes and healthcare as a separate expense. Why? Well, because healthcare, for instance, we're going to have to grow at a higher inflation rate. So you're not going to want to include that in your normal CPI or your normal CPI inflation basket, because we're going to be expecting basically twice the inflation target for healthcare. And so you can see through time when we break this out, just how much healthcare grows as an expense through time. We have these early years here where they're on ACA. Obviously, if they're not going to be controlling their income here to earn a subsidy, there's going to be some significant costs here. Okay, we include both normal premiums as well as some out-of-pocket assumptions. From then on, they're both going to be on Medicare. Okay, and we see Part D, Part B, Part D. We have a Medigap policy illustrated, and then once again out-of-pocket. We see the same thing here for this situation. And over here on the right, we have their annual amounts totaled, okay? And as we can see, early years are going to be spending quite a bit on insurance. Once they're both on Medicare, this target's going to drop. But they're going to start, first year they're both on Medicare. We see that this is 2025. Okay, their expenses that we're assuming is about $11,000 here. And then through time, by the time they reach their 80s, okay, they're looking at an expense that's essentially grown by 250% almost. Okay, and so this is why I urge you to keep healthcare costs separate. And so from 2 points I want to make on this, just how much, assuming a higher inflation, grows that expense that you're going to need. But then number 2, look at through time how much need we're going to have for that HSA through all of these varying costs that we have. Okay, just looking at 2025, Part B premiums qualify for an HSA. Part D qualify for the HSA. Medigap policy would not. Medicare Advantage would. But then out of pocket, most of the time is going to qualify. So right off the bat here, we see something like a $4,000, $4,500 target each that they're gonna be allowed to pull from their HSA in a given year. Okay. Obviously, if out of pockets are even more, that HSA, those HSA funds will even be that much more valuable. Okay. So again, common question: what happens if you have too much in an HSA? I don't think it's that big of a concern, but let's even talk through it. First off, after 65, your HSA, if it has too much in it, if you are never going to be able to pull the full qualified expenses from it, it's treated like an enhanced IRA. And this is a very important distinction. Generally, we don't like a ton of money in tax deferred accounts for RMDs. For when you pull that money out, it's going to be taxed. But an HSA eliminates the RMD. It's treated like an enhanced IRA where non-qualified withdrawals are taxed still, but there are no RMD requirements. So again, incredibly hypothetical scenario. Let's say you had $1 million HSA. Okay. Well, that $1 million HSA, you're still going to have to pull that money and it's still going to be taxed, but there's nobody forcing you to take money out of that. And that's an important distinction when we think about how an HSA can be used and be valuable. Okay. So how does it pass on to your heirs though? We had that question earlier. I don't really think I fully answered it. Well, for a spouse, it immediately transfers to that spouse with no tax penalties. Basically, that HSA becomes your spouse's HSA. It's pretty simple, pretty straightforward. Generally, you don't want to pass an HSA on to your heirs that are not your spouse. The reason being is because they'll have to use that, they'll have to distribute that full HSA in the year that they essentially inherit it. Okay, so again, super hypothetical scenario, they inherit $1 million HSA, well, that immediately becomes fully taxable for them. So you generally want to use up your HSA, whether it's on non-qualified or qualified withdrawals, prior to passing it on to any heirs. If it's passed on to an estate, okay, that it's going to be distributed to the estate at estate tax income tax rates. So again, those are generally higher. You want to avoid that. So given the option, if we would rather have too big of an HSA or too big of an IRA, generally speaking, when we leave out the estate planning conversation on it, we generally would want to have a bigger HSA than an IRA. Okay. Again, just something to know in the back of your mind. Let's talk about investing in your HSA. If it's your most tax advantaged account, we obviously want to get the most from this account. So how do we get the most from it on an investing standpoint? Well, here's a common mistake that we see. And I put an asterisk by mistake because I think it's a mistake generally with the clients that we plan for, but for some, it might not be a mistake. So let me talk through it and hopefully this will make sense. A lot of times when I see it, people come in, they have substantial assets. They might even have substantial cash balances. And they also might have a reasonably sized HSA. But so many times I see that HSA left in cash. Now on the surface, this might make sense or seem to make sense because at the end of the day, we don't know when healthcare expenses are going to be. We obviously know premiums. Those are set forward, more fixed costs, but we don't know out-of-pocket expenses. You fall, riding your bike, break your arm. Nobody knew that was going to happen, okay? So people leave their HSA in cash because if I'm going to use that for out-of-pocket expenses, well, I don't want to have it invested in the stock market, be in a 50% decline because of a 2008 type event, and now I'm pulling from that HSA when I don't want to be. Now, generally, I would say it's acceptable to leave your HSA in cash if you don't have the ability to pay expenses out of other resources. Okay, so if you live fairly paycheck to paycheck, you don't have a lot in retirement accounts, or you don't have large cash balances outside of retirement, I would say it's acceptable to leave that HSA. Basically, if your HSA is set up where that money is the only money that's set aside for healthcare costs, it's fine leaving that in cash. I'm talking about the majority of clients that we see that are in a situation where they have some cash buffers on the outside. And the reason I see this as a mistake is because you can pay healthcare expenses with non-HSA money. So paying it out of your checking account. Okay, you can keep the receipt, and then at any point in the future, you can take that receipt to the HSA provider, or at least provide it as proof to the IRS, and take that money and recoup the money that you originally paid out. So what does that look like? Let's say that this year you have a $10,000 out-of-pocket expense. Okay, you pay that from your checking account. Keep the receipt for that. At some point down the road, there's no time limit on this into the future, you can take the $10,000 out of your HSA completely tax-free. Okay, so given that, this is an incredibly powerful loophole that most people overlook with their HSA. The reason being is because given this loophole, what I would say is you should be investing very aggressively with your HSA because market declines aren't as much of a concern. Okay, if you have that $10,000 expense and we're in a COVID type decline where the market's down 30%, your HSA is down 30%, pay it out of your checking account, stuff that's already in cash that didn't lose money, wait till it recovers, and then use that receipt and recoup the money for it that you paid with that checking account. Okay, that way you can get the best of both worlds. You don't have the necessity of needing that money and worrying about the risk of the market, but you're able to use the market to grow that HSA as big as possible. Okay, so this is very similar to growth coordination that we've talked about with other accounts. Okay, we've talked about it in the past. Let's say you're invested 50-50 in stocks and bonds. You have $500,000, or you have $250,000 in an IRA, $250,000 in a Roth IRA. Well, most people put half the stocks, half the bonds in each account because it's simple. It seems to make sense. But what you should actually do is put the bonds, the lower growth vehicle, in the traditional IRA, put the stocks, the higher growth vehicle, in the Roth IRA, because over time, your Roth IRA is going to get significantly larger. Well, that's after-tax money. So we want that as large as possible. Okay, we want the traditional IRA to stay as small as possible because we have to, again, if we want growth, we want it in the tax advantaged vehicle. Well, the same works out in an HSA. And if you perform this change rather than putting half and half in each account, I believe this is over 20 or 30 years growing at interest rates don't change from bonds and stocks in either situation, but you basically get $350,000 more in after-tax value because of growth coordinating. So this is a huge benefit, okay, that you want to take advantage of. The same applies to an HSA. Growth coordinate your HSA. You basically get, that you want to take advantage of. The same apply. Sorry, I've got this open over here to see if we have any comments, but then I refreshed it and we got some feedback. So sorry about that. So you want to be using your HSA in a similar way to the Roth, where you're trying to grow it as much as possible, keeping in mind that you have that receipts loophole on the back end. So again, it shouldn't surprise you. I already kind of talked about it. My preferred investment strategy, if you have the cash set aside to pay out-of-pocket expenses, is be aggressive with that HSA. Okay, be long-term with it, be aggressive. Now, that being said, as we talked about earlier, there is a break-even point where you want to start using up that HSA money, because you don't want to pass a giant HSA on to your heirs. It's fine passing it on to a spouse, but you don't want to pass it on to your heirs. So there is a break-even point. I'd recommend talking with whoever you're using for financial advice to figure out the best break-even for you. But if we just look at simple compounding math, let's say we have 10 years of a couple maxing in HSA, and then they're investing that HSA for 15 years. Well, if we just leave it cash, and I'm probably being a little optimistic here on the interest rate you can earn on cash right now at 1%, but you're looking at $100,600 in your HSA. Okay, if you even take put some into growth, some into safety, and we're looking at a 4% interest rate, notice you get almost $85,000 extra in your HSA. Now remember, that's tax-free money when used for medical expenses. You didn't pay taxes on the front end. You didn't pay taxes on the growth. You're not going to pay taxes on the withdrawal. If you go, let's say fully in stocks, and we're just going to assume stocks average 7%, notice your improvement from the initial 1% interest rate is $235,000 almost. So a huge improvement by getting the most, using loopholes and getting the most out of these HSAs. Okay, so let's say your employer doesn't offer an HSA, or let's even say they do offer an HSA, but it's not that great of an HSA. How can you shop around for the best? Now, I don't, if you're watching this on YouTube after, or if you're watching this inside the Retirement Mastery Group, we've used Lively in the past. We get no kickbacks or anything from Lively. So I just think they're a great platform, all online. They do a very good job. They're a no hidden fees HSA. So certain HSA providers will tack on monthly fees. You want to avoid that. Okay, they're not a necessity. You don't need to pay fees to have an HSA. So there's a few out there that allow you to open an HSA with no fees. Lively is one. You can check out their website. I think they do a fantastic job. We have a few clients that use them as that independent shop. The reason that they're pretty cool as well is they offer a brokerage option that you can hook Lively up to TD Ameritrade. Now, we use Charles Schwab for all of our client custodian money, but they own TD Ameritrade. So TD Ameritrade is fantastic as well. They offer a brokerage option that basically you link up your Lively account to TD Ameritrade, and then you essentially have almost an unlimited universe of options where you can invest in certain funds, pick ETFs and whatnot inside of your Lively account. They offer you an HSA debit card, which basically they'll send you a card, swipe it for spending out of that HSA. And then, like I said, they're completely online. Again, don't go with an HSA where you're paying monthly hidden fees. These hidden fees can be $50, $100 a month. They vary widely, but basically you just don't need to pay them. Okay, Lively is no monthly platform costs, anything like that. So I think they're a great provider. Definitely check those out if you're shopping for an HSA provider. Let's talk about some other strategies for an HSA. First one is there is a one-time lifetime rollover. So once in your lifetime, you can roll over from an IRA to an HSA. Now, I've seen different videos where people make this out to seem like it's this giant benefit, this giant strategy. You're still constrained to the contribution limits in a given year. Okay, so basically one time you can take, in this year, it'd be up to $9,200 from your IRA and roll it to your HSA. Now, that if RMDs are going to be a problem, sure, that helps out a little bit, but it's not as big of a strategy as everybody makes it out to seem. Using HSA contributions during given years can really offset income in a great way. especially for tax purposes. So let's say that, let's say you're a high income earner, or even you're someone that has high variability. Let's say you're a real estate agent, okay? And in some years, obviously the real estate market's down, business isn't as good. Other years, because of commissions, you're making significantly more. Okay, well, in those significantly higher years, let's say you're in the 24 or even the 32% bracket. Well, remember, you get a deduction on income tax, state tax, as well as payroll tax. So if we add those up, just thinking in Wisconsin, let's say you're at 32%, then 6.27, or maybe even at that point, it'd be about 7.5, and then another 7.65. Well, you add those up and all of a sudden you're pretty close to saving 50% on that contribution. Okay, so using those in strategic years can really amplify the benefit you get from the HSA. I also really like it as a deduction to offset Roth conversions. Let's say you're fine with the tax situation you're in now. Let's say you're bumping just up onto the 22% bracket. Let's say you're even still working. Well, you might want to make a deduction, or sorry, make a contribution to an HSA, receive that deduction, and then perform a Roth conversion in that same amount. Essentially, those will offset each other and you'll still pay that 22% tax on a Roth conversion. Again, so using those in strategic years can be a great idea. And then using deductions to qualify for certain income limit hurdles. So let's say you could have done an HSA in order to qualify for a stimulus check. Obviously, you get a double benefit there. And obviously, let's say an HSA to qualify for a Roth contribution. Once again, you get a double benefit there. So using those at strategic times can really make a difference. And then obviously, we've talked about it a lot, using that receipt loophole. You can basically transfer that HSA into a Roth IRA. So let's say over a 5-year period, you have $25,000 in receipts that you have saved up. Let's say you're entering retirement and you're wanting to qualify for ACA. Well, you can use then $25,000 because you previously paid it out of a checking account. You have the receipts. So you have $25,000 that you could pull from an HSA and not have any taxes because you're basically exchanging it for those receipts. You're qualifying for the medical expenses. You just paid the medical expenses a few years ago. And so you can transform this HSA into a Roth IRA, and it can be really powerful in given years, especially when you're trying to keep your income artificially low for subsidies or whatever. Okay. Other health savings accounts that you might want to know about or you've heard about. People often get HSAs and FSAs mixed up, a flexible savings account. You can't have both at the same time. Often, we have heard of employers offering an FSA and not an HSA. And so oftentimes people will contribute to an FSA because they don't think they could contribute to an HSA. Don't contribute to the FSA, start the HSA on the outside. Generally, the reason I don't like FSAs is because they need to be spent by year end. So if you put $2,000 into an FSA and you don't spend it on qualified medical expenses, you either lose it to your employer, or you can roll over a very small amount to the next year. Generally, if an FSA, if they'll allow you, or if an employer will also contribute to an FSA, that might be a reason you might want to do the FSA over. But I would generally say HSAs are better than FSAs. Another type you might hear of is HRAs, health reimbursement accounts. Basically, those are very employer-employee oriented. It's a benefit that they'll offer to employees that'll basically stop after you're done being an employee. Biggest concern with these is you don't have control over. So for an HSA, you contribute to it, you control how much, how it's invested, when you take from it, etc. With an HRA, basically you need to have the expense, take it to your employer, get it reimbursed, and such. And so it's something that definitely, if your company allows it, use it. But HSAs, I think are significantly better. Okay, so in summary, we've covered a lot of different ground from a lot of different areas. HSAs are a fantastic vehicle. I would say after your 401k with a match, I would say it should be your next account that you can contribute to. After that, maybe Roth IRA, depending on your tax situation. But HSAs are incredibly powerful because you're basically, the money you're putting into that HSA gets to exit the tax system. Okay, you can invest it aggressively. You can use the receipt loophole in order to keep it invested aggressively. If you can pay those healthcare expenses out of pocket. And then you can use that later and essentially transform it into a Roth IRA. So I think HSAs are incredibly powerful. I would urge many of you to start them. Know that once you reach Medicare, you no longer can contribute. So that the clock's ticking as far as when and how much you can contribute to those. But again, I think they're incredibly powerful. So if you have any questions, either watching this now or watching this as a replay, make sure you go ahead and put those below. If you're watching on YouTube and this is your first time watching a Safeguard Wealth Management YouTube video and you like our content, don't forget to hit the subscribe button, be notified of all future videos that we release. We release videos weekly on our YouTube channel. So make sure you're notified. Always remember, you don't need more money. You need a better plan. Okay, right now, we just saw through this presentation that there's a way where you can save anywhere from, let's conservatively call it 10% to 50% by eliminating the tax man in terms of paying for healthcare costs by using an HSA. So this is a perfect example of how you don't need more money. You just need a better plan. Okay, contributing to that HSA at the right times can extend out your money by eliminating taxes from the equation. Okay, so always remember, you don't need more money. You need a better plan. Thanks for watching. Everybody have a great rest of the day. And again, let me know if there's any questions. Thanks.